Welcome to today's presentation. I'm Ashley Murphy, the founder and principal of Arete Wealth Strategists Australia. Today's presentation is Retiring to Australia, Financial Planning Considerations You Should Be Aware of. Let me get straight into what we have here. So, of course, no presentation is complete without our disclosures, essentially stating that this does not provide a substitute for personal financial, tax, or investment advice. That's what we do for our private clients, of course, and we've obtained all this information from what we believe to be reliable sources, but you would be wise to obtain your own professional counsel. That's the point of this one. Do be aware, if you see a topic that you're interested in and you know you can't make it, be sure to register anyway, because if you do, then we'll notify you once it's uploaded to the YouTube channel. You're welcome to come to the YouTube channel anytime you like and watch any number of the more than 50 presentations that I've done, and some of which I will reference today, because today is really a broad overview of a range of topics. If you want to go deep into investment restrictions, passive foreign investment companies, the HART Act and the exit tax, then I've done webinars just on those topics, and so you're welcome to come here and take a look at those. I would ask that you, if you do watch something on YouTube, just please like it and subscribe to the channel. It really helps out. That would be greatly appreciated. Okay, more disclosures. It seems a little bit about me for those that aren't aware. I really was born to do what I do as a cross-border financial advisor. I'm a tri-citizen, raised in Australia, born in the UK to an American mother. So I have American cousins and aunts and uncles and have lived there for 17 years. Very soon I'll be returning back after living in Australia for the last 2 years. And there's going to be an update to the Living in Australia series, where I ran the audience through all of the planning that we did in order to move and get ourselves set up. And now that we're planning to come back, there's a lot more planning and action steps involved with that. But anyway, I digress. I mentioned this is my calling. I was a corporate financial analyst. I sat in on subjects related to financial planning in university. Even when I wasn't enrolled in that, I did business management and IT. But anyway, it wasn't until an information session in 2008 at UC Berkeley Extension, and that was when the scales fell from my eyes, and I realized this is what I've got to do. And that's because I realized there was a way to sit on the same side of the table as clients and be a fiduciary to them in providing advice, because I think that's really the only way that financial advice should be provided, rather than where there's a sales conflict of interest. Anyway, a few other things mentioned there. Let me get straight into it, and Nancy, I will respond to your chats in due order. So we work with the following kinds of clients that you see here: Australian business owners living in the US, high net worth Aussie families in the US, or Australian families permanently relocating to the US, or the first two really are dealing with cross-border issues and maybe coming back to Australia, and the third one is really those that are going to stay in Australia. And so we've achieved all kinds of results for our clients, and we're one of the only firms that has this deep cross-border expertise between Australia and the US. With all that said, let's get on with today's presentation. So here today, we're going to talk about moving your US retirement accounts back to Australia. What's involved with that? The US treatment of superannuation. What does the IRS make of superannuation, and how should it be taxed? Third, best practices in foreign exchange. This is a very, very important topic that so many people overlook. They don't give it the attention that it truly deserves, and end up making just throwing money down the toilet by giving it to the bank or their poor foreign exchange service provider. Next, required tax filings. That's really going to impact US tax residents. Next, it will be investment restrictions facing Americans, and there's a lot of them, so stick around for that. And last but not least, the HART Act and covered expats. That's a increasingly problematic law for departing Americans, because there's a $2 million global net worth exemption that's not inflation indexed. And seeing what's happening with real estate and price is constantly increasing, more and more people are subject to that. And so I hope you stick around to hear about that one. But first, let's get into this. Moving your US retirement account back to Australia. The treatment is going to be fundamentally different, as it is for many of these things, depending on your US tax status. And as you know, well, unless this is your first presentation with me today, almost every presentation I begin by saying, if you're a US citizen or permanent resident, you're always a US tax resident. So the legal standards are different from the tax standards, which are actually different from the estate planning standards. So there's 3 definitions of residency. The one we need to concern ourselves with here is tax residency. So US citizens, legal permanent residents, you're a US tax resident. And for the legal permanent residents, the green card holders, they remain US tax residents just so long as they hold that green card in their hand. Even if it's expired, doesn't matter. You need to submit a form I-407 to the IRS, and there's a protocol to follow to successfully do that. Until such time, you're still a US tax resident, and that noose could find you, and we don't want that. So for them, you can't take penalty-free distributions until age 59 and a half. There are a few exemptions to that, but that's really the long and short of it. You're going to wait till age 59 and a half. Temporary visa holders, on the other hand, let's say you're in the US for some period of time, an E3 or an L1 or any number of other temporary visas, then that's different. That you move back to Australia, and provided you've been in Australia a sufficient number of days and your life situation really points to you having moved back to Australia, you're not a US tax resident anymore. And so you have a different set of options, which I'm about to explain. So what are those options? First, I'm going to talk about what US tax residents would do. And that is a US tax resident waiting until age what? Over age, yes, 59 and a half, correct? Oh, someone was quick on the dial there. Oh, Andrew, I thought you were answering that question, but you're getting ahead of me. Rule 72T. That is correct. So distributions according to regular US retirement accounts take place from age 59 and a half for US residents. And here's the 2023 federal tax rate. You're paying ordinary income when you take that money out. So if you're smart, then you take those distributions in years of lower income. Thus, you don't push yourself up into a higher tax bracket. So the ideal way to do it is to spread that distribution out over a number of years so you don't spike your income up into one of these higher brackets. And remember, the Tax Cuts and Jobs Act of 2017 that President Trump put into place is set to sunset, retire in 2025 unless other action is taken. And of course, there's no telling what other action may be taken, but these rates are all set to go up at that point in time. Next, pay progressive income tax plus a 10% early withdrawal penalty. There's what Andrew is referring to right there. You could do that. You can get your money out at any old time. If you want to follow these rules, you can. It is a bit of a hassle in terms of what is it that's substantially equal? Does it mean identical? And you need to do that for 5 years in order to get that particular treatment. Rarely it's the sort of thing you see discussed in webinars and Facebook forums and whatever, but I personally have never met anyone that's actually done it. But it is a thing. So next, for non-US persons, this is where things get interesting. You can take a tax treaty approach by completing a Form W-8-BEN. Don't forget to submit your 8233 also in your tax return, and you claim the tax treaty benefits. And that's where you would fill this out a little further below. And in that explanation, you'd say, well, I happen to be an Australian resident. Here we are. And subject to Article 18, if you read that, pensions and other similar remuneration paid to an individual who is resident of one of the contracting states, and there's only 2 contracting states in the US and Australian tax treaty. And if you're resident in Australia, one of the contracting states, in consideration of past employment, your 401k was funded, and 403b, whatever the case may be, was funded by past employment, shall be taxable only in that state. Now, to you and I, that reads very clearly. I think you'll find if you do your own research, talk to accountants, that's also very, very clear. The most conservative accountants, and I've spoken to many, many, many about this, they would say, well, there's actually this thing you need to watch out for, and you need to look at a private letter ruling and blah, blah, blah. So it's not necessarily so straightforward, but for the most part, that does favor Aussies in many, many instances. But you do well to consult your international CPA on that one. But as I mentioned, most of the time that does in fact work. So unfortunately, there is a disconnect. And what's happened is, starting about 2 years ago, Charles Schwab suddenly changed their tune. It used to be they were just fine with Article 18 and saying, hey, no withholding is necessary. If I am not a US person, I've moved back to Australia, I want my money back, thank you very much. The ATO will tax me a little bit on this. I understand that, that's fine, but no US taxation, thank you very much. Schwab suddenly changed their tune and they said, oh, no, 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 no. We're not in the business of being the arbiter or the judge as to whether any withholding shall take place or not. We're an investment firm. We hold investments in custody on behalf of our clients. If you want to take that up with the IRS, you take it up with the IRS. We are going to withhold 20% on you, and you're going to have to wait until April 15th of the next year, file your return, and get any withholding back. And we'll let the IRS make the determination if that's the case. Now, Schwab's not the only custodian in the world, of course, and I have found with another firm that I use with clients that we can in fact still get by with the 0%. They use their eyeballs, they read this, they use their brains and read this, and they say, yeah, that makes sense. It's why it was written the way it was written, is to say exactly that. So in any event, you probably will end up with an involuntary withholding with most custodians. So what can you do? The answer, I hate to say it, I hate to be the bearer of bad news, but the answer is not much. You can try and stamp your feet and stomp and whatever, escalate the matter to a compliance department, do a bunch of research and say, hey, guess what? This is, it conforms to every word that is used in this tax treaty. You can hire a tax attorney, but the problem there is that the cost of doing that, it's probably a couple $1,000 for an engagement there, and there's no telling what the lost what the cost of the opportunity cost you may have been able to employ with those funds. And quite honestly, temporary residents never really have more than a couple $100,000 anyway in a 401k. If it was millions of dollars that were in the 401k, and thus you're talking about hundreds of thousands of dollars being over withheld, I think that could make sense. But otherwise, option 3 here, the third bullet point, is just wait till you file a tax return and then reclaim that withheld amount. Okay. And by the way, I wanted to say, I invite you to just chime in with your questions. Let's make this conversational. I love it when people chat in and just say, hey, what about this or that or the other? That's totally welcome. US treatment of superannuation. So what is the, now we're going to kind of flip it here and say, well, what does the IRS make of my superannuation account? Because we know that when you're a tax resident of one country and you've got a foreign account, what you have to do is to try and think of how the tax regulations in the country you're in are going to make sense of that foreign account. And that's what we're doing here. So the IRS looks at superannuation and says, by golly, we don't have such a thing known as superannuation in our tax code. So what on earth is this thing? You'll see here retirement tax concessions are country specific. Really only Germany and the UK have any mention in their tax agreements to do with contributions being deductible or excludable. That's not the case with the Australian US tax agreement, in large part because superannuation didn't exist when it was first drafted. 401ks had actually just come into existence a few years beforehand, but this doesn't matter anyway. It's not deductible. So So what are they in that case? They're really going to fall to be one of two options here. The first two you see here, they're either going to be an employee trust, which is probably better for higher income earners, or a foreign grantor trust. And this is the way we make that determination. So an employee benefits trust is a trust created or organized in the US and forming part of this. This is the technical language right here. Essentially, let's just cut to the chase though. You're going to have your superannuation account treated like an employee benefits trust, where you've contributed less than 50% of the total account value, meaning most of it was the superannuation guarantee contribution of your employer or growth, one or the other. And you've got little discretion as to how the investments are managed, meaning there's just that 4 or 5 or whatever it is, number of investment choices within your super fund. That's most people's situation. We'll get to the foreign grantor trust in just a moment, but for that situation, the way the tax works there is contributions are taxable on the US side, so not going to impact the non-US individuals, but the dual citizens and the green card holders will be impacted by that. So contributions are taxable. In effect, so technically, yes, they are taxable, but because the Aussie tax rates are so much higher than the US, in actual fact, that you could still make contributions, you can still make contributions, and most of the time, you're not actually going to pay tax on that on that superannuation contribution anyway. Growth is tax-free. That's the good news. But here's where things get difficult: is at distribution time. Distributions are taxable. So if you're a dual citizen or a permanent resident in Australia, you've got your 401k. Sorry, other way around. You've got your superannuation account. You begin to distribute the account. You want to stay compliant, keep the IRS happy and off your back. And so you want to abide by all the tax laws that exist. You need to go and figure out what the taxable basis is of your superannuation account. And as simple as that sounds, that's actually a very technical thing. And that's something that I refer off to the various international CPAs that I use, is to figure out at what point did this account become taxable, and should distributions from the superannuation account be taxable. Neil writes in, have you looked at the totalization agreement between the US and Australia? Yes, I have. Go and check out my webinars on that exact topic. That agreement makes it clear super is considered Australia's version of Social Security and therefore would fall under the provisions of the tax treaty. Neil, thank you for your contribution. And I suspect you've been reading the work of a certain tax attorney who has gained some notoriety and is being pursued by the IRS. But that is not the full perspective, unfortunately. So I have to draw the line there on that one. It's not as simple as that. It is subject to interpretation. Different people can arrive at different conclusions, but I will say that that one absolutely does not pass muster. And the person promulgating that theory is being investigated for that, by the way. Okay, so moving on. The foreign grantor trust treatment, what's that look like? That looks like this. So the account holder has contributed more than 50% of the funds, or has significant investment discretion, or has the ability to revoke the trust, or has broad authority to revest title to the trust assets. All of these things sound very much like a self-managed super fund with non-employer contributions. So this is where you're contributing most of the money. That's where, and have a lot of control and can direct investments. That's where you're going to run into this foreign grantor trust treatment. How does that work? It's actually not as bad as it sounds, but it isn't ideal for higher income earners. And let me try and present a balanced view on this one. Okay, so the problem with it for higher income earners is higher income earners are naturally going to be in a higher tax bracket. When you are taxed, when your superannuation account is taxed at foreign grantor trust, any growth from year to year may be taxed at your ordinary income rates. So if that's the case, you're in your high income earning years, you don't want to be taxed at those higher marginal rates, and yet that's exactly what is happening. The good news is that when you come to take distributions from the account, your basis has been stepped up. So the taxation on distribution is very light, and that is good news indeed. So given my druthers, I would prefer the employee benefits trust treatment, because then you can take it at retirement, spread it out. You've got a little bit more distribution compared with the foreign grantor trust, where you're going to be paying tax on an annual basis throughout what's most likely to be your highest income earning years. This is a helpful little chart that I've got here that really breaks it out. So contributions, employee benefits trust, you can see taxable as ordinary income versus the foreign grantor trust, contributions taxed indirectly by determining the difference in the vested accrued balance. So in theory, you could make a contribution to your super account, and if the account declined that year in an amount equal to your contribution, then there would be no tax because there's no gain. It's mark-to-market taxation for the foreign grantor trust. Growth in the accumulation phase and retirement phase is earnings are tax deferred for the employee benefits trust really until distribution time, where it's taxed at your marginal rates above its taxable basis. Whereas for the grantor trust, you're taxed on a year-to-year mark-to-market basis, but that's stepping up your taxable basis. So at distribution time, the tax is much lighter. Okay, moving on to best practices in foreign exchange. I'll just slow down for 1 second there and see if there are any questions, concerns, any other points folks wanted to make it at this time. No. Okay. All right. We'll keep moving on then. So let's talk about foreign exchange. Foreign exchange is a very, very easy place to do it wrong and to waste money. And I mean significant sums of money. Now, obviously, today's presentation is going to be of interest to those that are looking to move back to Australia. You've probably gathered some significant portion of your wealth in the US, and therefore, if you're permanently moving back to Australia, there's a very high likelihood that you'll be moving large sums of money back to Australia. So if we look at this this spreadsheet right here, I'm going to just move out of the presentation mode for a second so that I can share this with you. Let's open the source. There is a chat that's just come through. Tracy, hi. If I release my green card when I move back to Australia, but I have a US-based annuity, how does that work in retirement in Australia for either monthly or annual minimum distributions? What a great question. Wow, the annuity one. You know, that has not come up in these webinar series that I've done. But let me just take if I release my green card, we'll move back to Australia. Okay. First, we'll have to determine if you're a covered expat, because that's like a choose your own adventure, and you go left or go right. That's a fork in the road. But I have a US-based annuity. I happen to really like US-based annuities, and there's more of them coming online that are free from commission. So they tend to be a much better product available to consumers. How does that work in retirement in Australia? That it's actually, I don't know the answer to that off the top of my head. I can tell you how it works in the US. There's an exclusion ratio. There's the percentage that you paid into the contract versus what it's grown to be. The growth is ordinary income taxable to you at distribution. And on the Australian side, I'm pretty sure, just reaching past the cobwebs in my brain on this one, you need to get a private ruling on it to specifically state what the tax is. That's what I'm pretty sure the treatment was there. It's all from my 401k, which is including my pre-tax match. Okay, yeah, that won't change that answer that I had there, but interesting. Okay, so going back here to look at foreign exchange, this is just a very simple spreadsheet that I created. Let's say you're moving from the US to Australia and you had $1 million US. You've sold your house, you've got your brokerage account you're ready to move back. Let's look at the difference in foreign exchange. Well, firstly, there's the rate today, 67.4. Historically, that's on the cheaper end. It's not the cheapest it's ever been, of course, but it's on the cheaper end. It's been edging up for the last couple of weeks, hovering around 66, but 67.4, that's not too bad. If you happen to own a bank, which none of us do, but if you happen to own a bank, you pay the interbank rate, which is no fee. So you get $1.483768 million Australian dollars for your million US. The next best you could do would be to have an account at Interactive Brokers, and they would charge a fee equivalent to about $30. That's the spread. See what we have here in column B? That's the spread. They charge basically nothing. How can they do that? Well, the answer is they're not in the business of doing foreign exchange. The foreign exchange is incidental to their primary business, which is being an investment custodian. Next best is OFX. This is the rate that we have negotiated for our clients. That's going to be about half of what you get with Wise and OFX. They've moved away from this flat 60 basis point pricing to algorithmic pricing. So it will vary a little bit, but on the whole, the rate that we've negotiated is going to be about half of what you're going to get with Wise or OFX. And we're beginning to talk about real money. I mean, on your $1 million, you just gave $9,000 to Wise, which is one of the better options out there, by the way. But you just gave $9,000 to them. People that use a bank, it's wow, what a shocking waste. This is one of the ways that people get fleeced. It's super easy to do it with a bank, of course, because it's your money, it's right there, and they provide that foreign exchange conversion natively to your user interface. But you're talking about a $30,000 loss, $30,000 fee on the rate that they're giving you. So I just wanted to draw attention to that. Next, we're going to talk about how someone moving for retirement would think about converting significant sums of money. The way we do it is we set up dollar cost averaging and do this periodic conversion using a limit order where we set a higher and lower bound, looking at the prior quarter's volatility, and then we'll leave that run for the quarter. Most of the time that will trigger either on the better or on the worse, on the high or low. And over time, we have found that actually results in a fairly decent improvement in the rate that people would get compared with if they had just converted right there, right then at the spot price. Another option that OFX offers is what's called a forward contract. So a forward contract it looks like this. It's essentially agreement that you would enter into with another party brokered by OFX, and you say, right, I think 67.4 is a great rate. I'm moving back to the US. I'm going to sell my car and furniture and all these other things. I'm going to have lots of money to convert back to US dollars. I want to lock in that rate now, but have that conversion take place in August or something like this. That's what a forward contract would be. And that would probably make a lot of sense if you were, say, selling your house and the rate was down. It was down at some level that you thought this is a screaming bargain, and I would do well to convert at this time or at this rate, but you can't convert at that time because you haven't sold your house yet. So that's when you enter into something like a forward. Okay, required tax filings. This is really going to hit the American citizens and legal permanent residents. So they're always subject to US taxation. Now, that doesn't mean they're actually going to pay double taxes. It just means they need to file their taxes. As you see here from the IRS, if you're a US citizen or resident alien, the rules for filing, blah, 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 matter regardless of where you reside. Okay. Temporary visa holders, on the other hand, that's really only going to be a factor while you're a US tax resident, and you're only going to be a US tax resident if you pass the substantial presence test. It's actually more complicated than what I've got here. It's 183 days in the current year, and there's a declining day formula going back the prior 3 years. There's a link to it right there. But that's to say that someone who has given up their US tax, their US residency, let's say, moved back to Australia on an E3, they need only go back to the US for 90 days in the subsequent year, and they could still meet the substantial presence test. So that's how that formula works, because it's going backwards as well to get to your 183-day count. But the two most common informational reports you need to be aware of are the FBAR, foreign bank account reporting, and the FAQ, the foreign, what does that stand for again? Foreign Account Transaction Compliance Act. So the FATCA limits, they vary by your tax filing status, whether single, married, filing joint, and your tax residency. So if you're overseas, then they've got a different limit compared with if you're in the US. There's a whole table that I've got on that. The assets are significantly higher, but more expansive. They ask for more types of assets. They want to know what you've got, what the American citizens and permanent residents have got abroad. FBAR, on the other hand, this is a really nasty, rotten form that they require. And here's what they want to know. Have you at any point throughout the year had cumulative account balances of greater than $10,000? And if so, you need to let us know about what those accounts were. So you have to figure out what your balance got to at any point throughout the year. Now, here's the thing. This is why I say they're rotten and nasty, is because if you don't do this, if you have willful non-compliance, the IRS is coming after you with a big fat stick, and they are going to fine you heavily, $10,000 per. Well, gosh, there was a case on this just lately, and I think it was upheld. It's either 50% of the account balance or $10,000. It's unbelievable, and it's just an informational reporting requirement. So there's nothing that happens as a result of letting them know about this. They just want to know that you have disclosed it. Of course, you need to report any foreign income that comes from investment accounts as well. That's where it would be relevant, but mostly it's just informational reporting. Here's another fun topic: investment restrictions facing Americans abroad. Well, number one on the list is always the PFICs, passive foreign investment companies. But Andrew writes, how about if a foreign spouse holds all the accounts? Then you're in the clear. If well, there's two provisos to that, Andrew. You're in the clear if they have no incidents of US personhood, like they're not citizens, they're not permanent residents. So that's the first one, and then the second one is there's an 80. What's there's a code section for where a non-resident can opt into the U.S. tax system. It's a once-in-a-lifetime election. I've done a webinar about it called Mixed Nationality Couples. I'm forgetting the code section. It's a 4-number code. But if assuming that they haven't opted in for that, then that would be correct. It would be, keep the accounts in your spouse's name and you're fine. Didn't delimit the penalties for FPAR? I'll have to look at that account there, but that's what I referred to recently, Eric, is that account change. There was a case to do with, they were either Swiss or German, or Swiss or a German Swiss, and they had a couple $1 million, and that case only settled about a month ago. And I think the limit was to do with, it went in the taxpayer's favor, not in the IRS's favor, but I could be mistaken there. But either way, even if I am mistaken on that, doesn't matter. The penalties are massive, and it's simply something you do well to comply with. Tracy writes, I also have in the US a cash value life insurance policy designed to generate future income in a rental property that we thought we might reverse mortgage when the time comes. In the US, loans are not income, so not taxable. How does Australia consider? Tracy, no one has ever been on a webinar of mine that has been so clearly destined to talk to an international CPA as yourself. This is significant. You need to talk to an international CPA. I've asked those questions before, and I can tell you they're very complicated and way beyond the scope of what we need to get into here today. Andrew, does a superannuation account need to be reported on the FR? I think it does. I think it does, actually. And that's a very good question. So thank you for that. I've just come back. I just want to confess, I've just come back from holidays, had a wonderful 10-day trip with my family in New Zealand. So that's why some of these things are a little bit rusty knowing that. But Andrew, yeah, I think super does. So Yeah, there you go. Robin's saying yes. All right, so back to PFICs here, people. So PFICs are bad news. It's essentially a protectionist policy the US has to prevent Americans abroad or permanent residents, US tax residents, as I've mentioned, from investing in foreign investment products. So the way they've defined it is if you hold some kind of investment where more than 75% of the gross income for the year is passive income, or more than 50% of the assets produce passive income, then you have yourself a PFIC. What does that include? Every single managed fund in Australia, every single ETF in Australia will be a PFIC for sure. What about, there's someone, no doubt, there's someone's about to write in and say, well, what about my superannuation investments? Turns out they're exempted if it's an employee benefits trust, and thankfully we've already been over that. If it's a foreign grantor trust, and in your self-managed super fund, you've got a whole bunch of managed investments, bad news, that's probably going to be deemed a PFIC. The thing with PFICs is, and this sounds ridiculous until you learn more about it, and we have a fairly educated audience here tonight. The thing with PFICs is actually the compliance with it is many times worse than the actual tax penalties, and the tax penalties are bad, so that's saying something. So it takes hours and costs hundreds of dollars if you're using a tax professional for them to complete the required forms per PFIC. So if you hold multiple investments in multiple managed funds, you're talking about massive compliance costs. And we haven't even spoken about the tax treatment for that. And we're not going to speak about it because I've done another webinar on that. But some other things that come up would be mutual funds. This is US mutual funds, to be clear here. So let's say you move to Australia, you say, I've got this fantastic investment account with all these mutual funds in it. What's my situation going to be in Australia? Well, here's the thing. There's multiple levels of regulation. There's tax regulations that affect us as individual taxpayers. There's compliance regulations that affect mutual fund investors. There's Siri eavesdropping on me. There's compliance and tax obligations that affect mutual fund and investment companies, and there's compliance and tax obligations that affect the custodians. In this case, we're just talking about the mutual fund companies, and the laws that govern them say that if a mutual fund is not made available for distribution in a country where someone is resident, then it is not available, quote unquote, not available for sale. Is this enforced that vigorously? Not really, but it is a hassle if you want to rebalance, if you want to really do anything with your mutual fund at all that's not supported in the country that you're in. The easy way around that is simply to invest in ETFs, exchange traded funds, where this does not apply at all. Because what we've found is that even though there are many fantastic American mutual funds out there, to try and figure out the ones that are available for sale in Australia versus those that aren't is a hassle. So we just don't do it. We just stick with ETFs. What about account closures? This is one that has been with us for a number of years, for the past dozen years or so. This has really picked up steam since FATCA came into effect. And what it is it's new enforcement of old rules, but there was a new rule that came along, and technology has made it easier through information sharing, automatic information sharing, has made it easier for regulators to keep a track of things. But we're talking about rules that have been around for years and years, but it was mostly FATCA that caused the financial institutions to have to pull up their socks with regards to compliance on this one. And so as a result of that, we've seen a number of changes come about, namely account closures. Just here's a nastygram from your brokerage firm. They've said, thank you very much, you've got 30 days or we're closing your account. I've personally seen that with JP Morgan, with a client who has been a client now for a couple of years. They were told you got 30 days to get the heck out of Dodge. Restrictions on mutual funds and ETFs, we just saw that. It's more mutual funds in Australia. ETFs can be impacted in Europe. That's different because they have MiFID to worry about there. High account minimum balances. They could say we're only now going to work with offshore to the US, that is. Clients who have $1 million in their accounts, sorry, if you don't have more than that, we're closing your account. So long, have a good life. Move accounts to special groups within the firm. That's a tough one. They move, we see this with Schwab, we see this with Morgan Stanley, where they have their international divisions. But what you need to know, it's self-serving of me to say that, so I'll confess that. What you need to know is that they are not financial planners. They are just investment managers. So if you say to them, well, what about the taxation of my superannuation account? Or, what's the ideal age that I should take, Social Security out or whatever, they don't know anything about that, and they are not going to help you. They're just going to say, we are here to invest your funds in a compliant manner now that you're an offshore person. Or they may restrict activity altogether to when you're only physically present in the US. So who's doing this? There's lots of firms that we've heard of that may be doing this. Now, do keep in mind that them doing it at all does not necessarily mean Australia. There's a patch quilt of application of this, whereas some firms will work with some countries, but they won't work with others, and vice versa. It is not uniform at all. But here is a sampling of firms that we've heard of. Do these service restrictions apply to US citizens living in Australia? Absolutely, Hugh, yes, they do. They absolutely do. Does every one of them do this? No. Raymond James, they sent out an email, it must have been January 2 years ago, or December little over 2 years ago, and they said, thanks very much, but we're done. So that led to the exit of some service providers that were working with Australians. Vanguard, I think they're okay in Australia. Morgan Stanley, I don't know. Fidelity, I think, is okay in Australia. Merrill Lynch, I don't know. I think that's probably a private client, one of the higher end service divisions. Ameriprise, they're an interesting one. I recently had a client join, and the situation with Ameriprise is they are not happy for you to be in Australia, but they kind of have a wink, wink, nudge, nudge approach where if you just don't tell them, your advisor at Ameriprise will say, don't update your address, because if you do, then we'll restrict your account. So there's a lot of that sort of thing going on, I should mention. But moving on, Hard Act and covered expats. This is always a riveting and interesting topic, this one. I hope you think so. So the Heroes Earnings and Assistance and Relief Act was passed into law in 2008. The funds of this are designed to help US military service members. And they do that by applying 3 tests that we're about to go through to folks that are either relinquishing their US citizenship or giving up their green cards. You must meet one of these 3 tests that we'll talk about. So if you do meet one of these tests, you're assigned this nasty term. You are deemed a covered expatriate and guilty before the IRS. So the Hard Act stipulates the individual will be assessed an exit tax when they relinquish their US citizenship. It's not the end of it either. I think this is a nasty, nasty tax for what it does to inheritances, folks that receive inheritances. So under the Code Section 877 and 877A, the Hard Act affects these 2 folks, a long-term US permanent residents, anyone who's been in possession of a green card for the past 8 of the past 15 years, who expatriates, and then you're deemed a covered expat. Let's go have a look at this, and then we'll come back to that, what we just looked at a second ago. Here's how it works. Is the individual a US citizen or long-term resident of the United States? Long-term resident, what's that? We just looked at a second ago. It is 8 years of the past 15. Have you been in possession of this for 8 of the past 15? And are you now, let's move to step 2, did the US citizen relinquish citizenship, or did that long-term resident cease to be a long-term resident, i.e. by surrendering? What's that mean? Submitting I-407 through the proper protocols to the consular. And did you meet one of these 3 tests? Well, here, the first one is really the annual net income tax liability. And you can see there for 2021, what were we up to? In 2020, it was 171. It's indexed annually, of course. But you got to be making serious money for that to apply. You need to be, for a single filer, it's about 570. For married filing joint, you got to be making about 680 or so, and have had that for the past 5 years to have an average tax liability as high as that. Excuse me. Sometimes we get executives that get big bonus payouts, maybe $1 million or 2 or 3. And in one fell swoop, that's just going to skew the whole average of the past 5 years. Nothing they can do about that, and they're going to be covered expats just because they earn too much money as far as this is concerned. The section that I think is especially unfair here is this global net worth of $2 million, because that's not inflation indexed. That's $2 million, and as real estate prices, asset prices increase, more and more people are falling prey to that particular one. There's planning work that can be done, and we engage our clients in that planning years ahead of time, be that asset shifting or changing the nature of assets. There's a lot that can be done to avoid it, but that's the second test, is the global net worth. What do you have in the couch cushions, under the mattress, in your superannuation, everywhere? And worst, by the way, hold on to your hat here, worse, any account held in joint title counts 100% in your name too. Okay, Tracy wrote, they need to consult with you first and put those bonuses into something that's not taxable income. Well, maybe not so straightforward, because once you have once you've received it, it's taxable income, and it's going to hit. There's no Tracy, I kind of know where you're going there. You might be talking about insurance products, but there ain't nothing that can be done about that if that's how it's structured with those senior execs in those situations. So, yeah, it doesn't matter. I mean, I have never seen a situation ever where an executive at a big company has had the ability to institute a 457 deferred compensation plan and not have it taxed. So I do not think that's possible. Katrina writes, so for couples that would be each or combined, well, we have to be clear there. So assets held in your name are only counted in your name, but assets held in joint title are also counted 100% in your name. And then if your spouse has the same legal US legal status as you do, then it's counted 100% for them too. So you're actually hinting at one of the planning strategies that we employ, and that is, you want to, for that kind of situation, you want to disentangle those joint accounts, because each spouse is paying 100%. So Robin writes, if my house is joint owned, it counts as all mine. Bad news. So how do they value the assets like a property? Good question. It's actually a really good question. I'm glad you asked that, Tracy. Here's the thing, is if someone were moving back to Australia for retirement, so they're done with the US, it's all over, thanks, it's been great. In all likelihood, they probably wouldn't retain that property if it was a primary residence, they wouldn't retain it anyway, because rental yields haven't been that great by and large. But maybe that situation, you know, it's going to vary depending on your situation. If it is a primary residence, remember, you get a $250 single $500,000 capital gain exclusion on the gain of a primary residence. So it's often better to sell that beforehand, and we'll know exactly what the property is worth because that's what it's sold for. That's the case at the primary residence, and you can double up your exemptions in doing that. If, however, you decided to turn it into an investment property, then it would need to be valued. So how do they value it? You get a valuer, and they say this is what that property is worth. This includes, Katrina, this includes everything, absolutely everything. Like I said, couch cushions, mattresses, superannuation accounts, everything, anywhere, because the tax purview that the IRS has is global in nature. So come back here. All right, so what are those three tests? You saw that here, it's spelled out. One thing to mention with the asset test, it's not all bad news despite this $2 million limit. because they will give you a capital gains exemption that's fairly generous. It's up, I think in 2023, it's up over 800,000 now. Last year was 780, I think as it was. So that's if you have a capital gain on assets that fall under this mark-to-market treatment, the all other asset bucket that we're getting to in just a moment, then you would get that exemption. And if you were smart about the sequencing of your exit, then you would sell a primary residence, because then you get a 500,000 exemption there, and then you could have another 800,000 of gain before an exit tax would apply. What about assets held in a trust? Oh, Colin, they don't forget about that. In fact, there's a special category even for things where you're a non-grantor, meaning if great Uncle Jim left that for your benefit in a trust that you don't control, but you're the beneficiary of, they ask about that too. So I can't be any clearer than saying they want to know everything anywhere, and if you don't disclose it, that's tax fraud. Simple. So who's affected by it? What does it mean to be a covered expat? The HUD Act affects both the income and estate/gift tax system. So a covered expat needs to worry about the income, the exit tax they'll incur at exit. So there's the first one. But here is where it's really nasty for folks that may have heirs that they're thinking. So they're thinking of relinquishing, and they may have US citizen heirs. Well, guess what? Uncle Sam's not done with you, even from the grave, because there's an inheritance tax of 40% that can hit the gross value of covered gifts or covered bequests. Before anyone asks about that, I don't actually know much about that, and nor does anyone. And I mean, tax attorneys, you'll have a hard time finding solid answers to that one. And the reason why is because it's a relatively new tax. Remember, this only came into effect in 2008. And we're talking about the heirs of people that have relinquished. So in 15 years, people that have relinquished, how many of them have died? There's not that many. I mean, it's in the tens of thousands, perhaps even hundreds of thousands that have relinquished, but we haven't seen many examples of this where the IRS has come after folks for covered expats heirs who are US individuals. But it's there. It's a sleeper. It's like a time bomb waiting to go off. Now, I mentioned I mentioned that there is an exit tax. What's important to understand is that it's not one single monolithic tax. It's not you exited, you get hit with the 40% exit tax. It doesn't work like that. It's much more complicated and nuanced. So what they do is they divide up your estate into these 5 categories. There's specified tax deferred accounts that would be, say, 401ks, IRAs, Roths, etc. Actually, Roths may be under the eligible deferred compensation. But there's your traditional retirement accounts right here. Eligible deferred compensation. There's your 457 type accounts. There's your cash value life insurance. There's a host of things. Ineligible deferred comp, that might be your incentive stock options. Rarely does anything come under there, actually. Next, going back to, was it Colin's question, or someone asked a point earlier before? Oh, it was Colin. Beneficial interest in non-grantor trusts. Oh, yes, there it is. They want to know about that. Mark-to-market assets. That's everything else, and that's the category that's mostly going to be your capital gains assets, your investment real estate, your investment account with your stocks and mutual funds and ETFs and so forth. That's the one that has the exemption applied to it of somewhere around $800,000. So what I've found with clients is, in going through and doing a very detailed exit tax analysis, more often than not, when we plot this out, if younger or mid-career folks are thinking, oh gosh, I don't want to be a covered expat, I don't want to have this exit tax apply to me, that's just going to be the worst thing in the world. It's actually not the worst thing in the world, because very often individuals that have moved to the US did so for financial reasons in the first place. And they find if they move back to Australia, they're probably paid less in a nominal salary amount. Their taxes are higher. They're single tax filers, because in Australia, we don't have a tax filing status. Everyone is effectively single. And so even though there's an exit tax, when we do these long-term projections, taking everything into consideration, your net estate is growing by more than what it would be if you moved back to Australia with lower income, higher taxes. So it's not great. I wish I had better news, but these are the tax laws that we must comply with. We can do planning. There's certainly planning that can be done to minimize it, but more often than not, it's a matter of mitigation and minimization than avoidance altogether, because you cut your nose to spite your face kind of thing. All right, that wraps it up for what we have today. Next month, I'm going to be joined by Donald Griffin. I'm very excited to hear from him. Donald is a very fascinating guy. He is a cross-border estate attorney, originally from Ireland, but he holds a very interesting designation here. He's a lawyer, obviously, but the TEP, that's the designation granted by the Society of Trust and Estate Planners for international trust and estate planners, and that's exactly what Donald does. So he's going to be talking about estate planning considerations for Americans abroad and returned Aussies, looking at wills, trusts, gifts, and estate taxes, guardianship for minor children, and general strategies that we might think of. So come join us next month. That's going to be May 16th in the US, 17th in Australia. If anything I've spoken about here today has sparked your interest and thought, maybe I should really talk to Ashley, then feel free to reach out. You just need to come to our website. There it is, arete-wa.com. Click on the Get Started. There's a few questions there, and then we can find a time to have a chat and see if we might be the right advisor for you. Other than that, happy to answer questions in the time that we have remaining here. It's been an interesting session, very interactive. So thank you for everyone's questions here today. And Tracy, I should mention, I used to be an instructor at UC Berkeley Extension in insurance. So when you're talking about cash value life insurance and annuities, near and dear to my heart, but generally in a cross-border context, they don't work as well. Cash value life insurance in particular. Australia has a special provision to catch that out. So it works in the US, it may work in the Bahamas or the UAE, where there's no tax, but in Australia, they're onto that one. So it doesn't work in a cross-border context. And the annuities, they can, but you'd want to have a lot of money in that to make it worth your while. I was thinking it'd be better to give up my green card when I move back. Yep, maybe. Is there any reason you think I should want to keep? That's a fine question. I think it's very individual, very emotional. Obviously, a lot of folks are very attached to their US legal status. If you have friends and family, that might cause you to want to come back to the US for greater than 90 days. Otherwise, you can just come back on an ETA tourist visa. Beyond that, I don't really see that many advantages. That's just my opinion. Nancy, hey, Nancy, hope you're well. Been thinking about you. Great session. Thank you so much. And congratulations on being a grandmother. You must be so proud. And I hope Nikki is doing well. I think that's everything. No more chats here. So thank you next month. I hope you can join Donald and I for what will be a very interesting discussion. Thank you, Katrina. Thank you, Jay. Thank you, Jen. Have a wonderful rest of your day.